Good afternoon, everyone, and thank you for joining us on this webinar for the NCUA 5300 Call Report Form Changes. I'm MJ Thor, the Director of the Division of Systems in the Office of Examination and Insurance. We will have time to answer questions at the end of our presentation. To submit a question, please use the Submit Question box in your webinar console. Here are 3 technical tips to make sure that you can see the console and hear the presenters. First, make sure you allow pop-ups from this website. Second, if your display is not clear, set your screen resolution to at least 1024 by 768 to see the presentation. Third, if your volume sounds too low, check to ensure that your volume is all the way up on both your computer and inside the webinar console. If that doesn't work, plug in external speakers or headphones. Before we start today's training, I would like to introduce the NCUA Chairman, Honorable Todd Harper. He would like to say a few introductory remarks. Sir, the floor is yours.
Thank you so much, Mary Jo, and good afternoon, everyone. I am pleased to join you and appreciate your interest in today's webinar, which focuses on improvements and changes to the call report, beginning with the March 2022 reporting cycle. I would also like to thank NCUA's Director of the Office of Examination and Insurance, Kelly Lay, and her entire team for planning and coordinating this webinar, as well as their steadfast efforts to modernize the agency's data collection efforts over the last several years. The NCUA knows that these changes to the call report have generated both questions and apprehension among credit unions, vendors, and stakeholders. I, however, want to assure you that the goal of today's webinar is to answer as many of your questions as possible, as well as to alleviate as many of your concerns as possible. This webinar will also provide valuable information that will help all of you better understand the benefits of and navigate through these changes. But first, let me briefly summarize how and why these changes to the call report came about. Nearly 6 years ago, the NCUA launched its Call Report Modernization Initiative that examined how changes to the agency's data collection practices could enhance the value of the data it collects and reduce the reporting burden for credit unions where appropriate. Throughout this initiative, the agency engaged with stakeholders through multiple requests for information and meetings with vendors to develop a more streamlined call report. The modernized call report was initially ready to be implemented in 2019 when the risk-based capital rule was scheduled to go into effect. But the effective date for the risk-based capital rule was delayed until January 1st, 2022. Along the way, the NCUA board also proposed and finalized the complex credit union leverage ratio, or CCULR, which went into the effect at the start of this year. As such, the new call report form for March 2022 includes improvements from the Call Report Modernization Initiative, changes resulting from the risk-based capital and CCULR rules, and updates to accounting standards and regulations that have occurred since 2018. While the call report collects more information in some areas, it still reduces the number of fields overall. While streamlining and modernizing the call report has its benefits, the NCUA recognizes that change is difficult. We also understand that credit unions and vendors need time to work through these modifications and update their systems. So I want to reassure all of you that the NCUA recognizes this need and that we are committed to working with you in implementing these changes, especially for the first few call report cycles. Throughout today's webinar, you will hear more about the changes to the call report form, its related materials, and the resources the NCUA has available to assist you with completing the new forms. Since the start of the pandemic, The NCUA has not imposed civil monetary penalties for the late submission of call reports, and we will continue this practice for the March 2022 reporting cycle. Also, if you cannot meet the submission deadline, our examiners will work with you and your credit union to assist in developing an estimated call report for your credit union if needed. We know that there will be a learning curve, but our goal is to make the transition to the new call report form as easy as possible. In closing, I urge you to make the most of this webinar by asking any questions you may have. Should you have additional questions or concerns while completing the new call report, I encourage you to contact our Office of Examination and Insurance or your regional NCUA office. As always, be safe, be well, and be kind. I'll now turn back the program to MJ. Thank you.
Thank you, Chairman. Hello, this is MJ again. I will start things off by providing more detail on how we got here. The NCUA began the Call Report Modernization Project in June 2016 by posting a request for information in the Federal Register, seeking comments about the call report. Key goals of this modernization project included reducing the reporting burden on credit unions, improving our off-site supervision capabilities, and updating the organization of the call report forms and related instructions. In response to the request for information, we received 53 comment letters from stakeholders containing a total of 684 individual comments and recommendations. In response to the agency's outreach, stakeholders shared their desire for the NCUA to reduce the size and complexity of the call report, reorganize the schedules to group items logically, reduce overlap, and improve the instructions. The modernized call report form and instructions were made available on the Call Report Modernization website in January 2018. After February 2018 board meeting, the NCUA published the proposed call report changes in the Federal Register and again requested public comments. In addition to requesting public comments, the NCUA conducted outreach efforts and consulted with credit unions, credit union leagues, state regulators, and the NCUA's regions and examination staff. The NCUA began the Paperwork Reduction Act public comment process for the March 2022 call report in September of 2021. The initial 60-day comment period was posted in the Federal Register on September 28, 2021. The call report form and related documents were posted to ncua.gov in November 2021. The call report materials were revised after the 60-day comment period and again after the December board meeting. The final call report form was posted to NCUA's CU Online web page on January 25, 2022. The form we are about to discuss represents the changes resulting from the Call Report Modernization Project, the feedback received, and subsequent changes in accounting standards, regulations, and laws. The March 2022 Call Report form includes schedules for risk-based capital and the complex credit union leverage ratio, thus reflecting these recently effective regulations. For the March 2022 call report form, we improved the organizational structure of the form. We improved the call report instructions. We added the RBC schedule, replacing the original 2018 prototype, and most recently, we added the CCULR schedule, including some account code changes that inform both the RBC and CCULR schedules. For many credit unions, there is a reporting reduction of account codes by as much as 18%. This chart demonstrates the resulting reduction in reporting burden. Credit unions with $500 million or less in assets have an 18% reduction in fillable account codes, and credit unions over $500 million have a reduction of 16 to 8%, depending on whether they qualify for and elect CCULR. The difference between the 18 and 8% for fillable account codes is due to the off-balance sheet exposure reporting, CCULR and RBC account codes. In spite of this reduction in reporting, we know this transition is not without challenge due to the changes in the characteristic of data and the corresponding account code name changes. If you have not already done so, please download the form from the Resources section of your webinar console. I will now turn this over to Paul to begin discussing the actual call report form.
Good afternoon, everyone. Good afternoon, everyone. Thank you for joining us for today's webinar covering the March 2022 call report changes. I'm Paul Mackey from the Office of Examination Insurance. If you'd like to follow along by looking at the form, we included a link to the form and instruction in the Resources section of the webinar console. I will begin with financial statement. The statement of financial condition and the statement of income and expense do not have significant changes. The biggest change is the relocation of maturity distribution schedules from the face of the financial statements to various schedules. The investment maturity distribution schedule moved to Schedule B. The borrowing maturity distribution schedule moved to Schedule C. And the share maturity distribution schedule moved to Schedule D. We expanded the reporting of foreclosed and repossessed assets to segregate consumer and commercial foreclosed and repossessed loans. OTTI was relocated from the statement of income and expense to Schedule B. Schedule A is where the changes to the call report are most obvious, as it now includes loans, delinquency, and charge-offs, whereas previously, loans, delinquency, and charge-offs were not in a schedule and were standalone items. We also separated consumer real estate loans and commercial real estate loans. Previously, commercial loans with real estate collateral of any type were included in the real estate loan schedule. Now, only 1 to 4 family residential and other consumer real estate loans are on the real estate loan schedule, and the commercial loan schedule continues to have its own detailed collateral categories that include real estate. We retired most account codes used to collect troubled debt restructuring, and new for March, we only collect the total number and dollar amount of TDRs outstanding. We reduced the reporting for delinquent loans by removing the requirement to report the number of delinquent loans for each loan type by days delinquent, and we removed numerous additional delinquency information categories. The delinquency and other charge-off loan categories now align with the non-commercial portion of Section 1 and Section 8, the commercial loan section. This was done to eliminate reporting the same loan in numerous sections, make reporting clearer, and reduce burden. Schedule B was redesigned to better provide investment information that is consistent with GAAP, and it provides more valuation information. Maturity distributions were moved from the balance sheet in the old call report to Schedule B. Schedule B is now the new home for OTTI reporting. In Schedule C, we added the off-balance sheet exposures section to inform RBC. Therefore, it only needs to be completed by those credit unions with assets in excess of $500 million. We centralized reporting of unfunded commitments, contingent liabilities, and sources of funds into Schedule C. The borrowing maturity distribution schedule was relocated here from the Statement of Financial Condition. We also expanded details of borrowing arrangements to include outstanding term and other borrowings and assets pledged to secure all outstanding borrowings. Schedule D now includes the share maturity distribution, additional share information, and NCUA insured savings computation. These items were relocated here from the Statement of Financial Condition. Schedule E represents various topics relocated from other areas of the call report, including grants, number of employees, information on new branches, international remittances, QSOs, and money service businesses. We revised Schedule F derivative items by reducing the number of account codes for data consistent with the final rule from 2021. We no longer need to collect the weighted average years to maturity and have also reorganized the product listing shown on the slide. These changes will provide further clarity on the use of derivatives. Please refer to the call report instructions for specific information. Credit unions are not required to provide input on Schedule G unless they have chosen an alternative asset option, made a one-time adjustment to undivided earnings due to the adoption of ASC Topic 326 for an expected credit losses standard, CECL, or completed a merger or acquisition after December 31st of 2008. We updated the automated net worth ratio section of the prompt corrective action worksheet to display net worth, CCULR, or RBC ratios. Only complex credit unions are required to provide input on Schedule H. For credit unions with more than 500 million assets, a new schedule is added to calculate the complex credit union leverage ratio, CCULR. Credit unions with more than 500 million assets must answer question 1. Does your credit union have a CCULR framework election in effect as of the quarter end report date? The Capital Framework webinar will provide additional training on CCULR and this schedule. For credit unions with more than 500 million in assets, Schedule I was added to calculate the risk-based capital ratio. Schedule I is the only applicable to those credit unions that either did not elect CCULR or do not qualify for CCULR. The Capital Framework webinar will provide additional training on RBC and this schedule. E&I is presenting these additional topics to the industry. The changes to the call report form and instructions are the culmination of the call report modernization project. We hope you will agree that we addressed many of the staff and industry suggestions to streamline the call report by removing redundancy. In addition to the call report form and instructions, the financial performance report and risk reports will also change. You can also download a mapping document which maps the changes from the December 21 call report form to the March 2022 call report form. If you have questions, please reach out to your district examiner or regional office. Eastern, Southern, and Western regions have designated personnel to assist with call report and RBC questions. You may 14 questions via email at cuonline@ncua.gov. Alternatively, the Office of Examination and Insurance may also be contacted at enimail@ncua.gov. I'll turn this over to Susan Brown and MJ to address your
Thank you, Paul. Good afternoon, everyone. My name is Susan Brown, and I'm here with MJ. And we are now going to take some time to answer some of the questions that we've received. As a reminder, we will post answers for the questions that we do not get to today at a later date. So let's get started. The first question I have is a question for MJ. So, my credit union probably won't be ready to file an accurate call report for March before April 30th, 2022. Will the NCUA be delaying implementation of the streamlined call report due to credit unions not being ready? MJ?
Thank you, Susan. This is MJ. So as the chairman mentioned, we are not extending the deadline for the March cycle. However, we will work with credit unions that are experiencing difficulties on a case-by-case basis, and we're going to provide information on how to receive that help. Thank you.
Thank you, MJ. The next question I have is for Allison. Allison, can my credit union get an exemption from having to comply with CCULR?
Oh, Susan, this is Allison from, I'm the Chief Accountant of the NCUA in the Office of Examination and Insurance, and I wish I could say yes. However, just last week, the FASB board met and deliberated on some agenda requests and said no to any more deferrals. So it will become effective for credit unions January 1st of 2023. I will caveat that, though, that credit unions under $10 million with our new regulation revision from last year will not have to comply with CCULR. They just have to have an allowance that is adequate enough to cover known and probable losses if permitted by state law, if they are a state-chartered credit union. However, all federal credit unions will not have to comply with CCULR if they are under the asset size of $10 million. Thank you, Susan.
Thank you. The next question I have is for Laura. My provider will not have a delinquency report ready for us to report into the new delinquency date ranges. What should we do?
Thank you, Susan, for the question. This is Laura. If you currently have a delinquency report that displays the information on delinquency based on the 30 to 59 days or 60 to 179 days, then continue to report in the most appropriate date column in the March call report. For example, if your delinquency on either the, for example, report your delinquency on either the new 60 to 89 day range or the new 90 to 179 day range, depending on which is closer to the delinquency date. For credit unions under $5 million, this will not impact any ratios. However, you should correct and file a corrected call report for March once your vendor has that information or you're otherwise able to determine and report the information for delinquency as requested. That concludes my answer.
Thank you. The next question I have is for Tom. Tom, is the RBNW requirement eliminated for credit unions under $500 million beginning January 1st, 2022?
Thanks very much for the question, Susan. Hello, everyone. This is Tom Fay, Director from the Office of Examination and Insurance. There are a few questions with regards to the capital adequacy standards for 2022. So let me offer a response that's a little bit broader than the question and hopefully answers a few others that we're seeing coming in terms of what credit unions will be subject to for capital adequacy starting in 2022. First, you should know we are conducting a separate capital adequacy standards webinar on February 23rd, and that information should be out for you to register on, and we're going to be covering both risk-based capital, the CCULR, and capital adequacy standards in general, much more in depth than we will today. Secondly, in terms of answering the question, you know the regulatory capital framework for all credit unions starting in 2022 will be subject to new standards. If your total assets at any reporting period is $500 million or less, then you will only be subject to a net worth ratio. So the risk-based net worth ratio that we know through 2021 no longer exists for credit unions with assets of $500 million or less. So again, you will only be subject to a net worth ratio for PCA standards, for PCA classification. If you are above $500 million in assets at a reporting period, then you are subject to both a risk-based capital framework in parallel with the net worth ratio. So therefore, those two ratios would work in concert to determine your PCA classification. If you qualify, and here's a third framework, if you qualify, you can opt into the CCULR framework. And there are requirements and eligibility criteria in order to opt in. You can opt into the CCULR framework, which would satisfy your risk-based capital framework reporting requirements if you meet the eligibility and the requirements. Thank you.
Thank you. Okay, the next question I have, I'm going to give to MJ. MJ, what is the due date for the call report in April 2022?
The call report due date for the March cycle is April 30th, 2022 at 11:59 Eastern p.m. Also, in case people do not know, the NCUA made a change during the pandemic that always sets the call report due date to be the 30th day of the month following the quarter end. So therefore, it will always be April 30th, July 30th, October 30th, and January 30th. That concludes my answer.
Thank you, MJ. I'm going to stick with you for the next question. The next question is, when is the Capital Framework webinar?
I just pushed the slide to the audience so that they can see the upcoming webinars, and they can register via the agency website.
Great. Thanks, MJ. The next question I have is for Rick. How should ABS with guaranteed student loan collateral be reported? As federal agency securities or other ABS?
Thanks, Susan. This is Rick Mayfield. I'm a senior capital markets specialist in the Division of Capital Markets in E&I. So they should be reported one of two ways. So typically, if a federal union is purchasing what is known as student loan ABS under the General Investment Authority, it is actually through a political subdivision of a state. So if it is a revenue bond issued by a state corporation, and the one in Texas, I believe, is Brazos, it would be recorded as a security issued by a political subdivision in the United States. Now, if it's a traditional asset-backed security, it should go into the non-federal agency asset-backed security section. That concludes my answer.
Okay, thanks, Rick. I'm going to stick with you for kind of a long question here. So here we go. On the new call report, page 14, federal agency securities are divided between guaranteed versus non-guaranteed, and again between debt instruments versus non-debenture instruments. These distinctions were not present on the historical call report. The associated instructions also don't provide much guidance to be able to make a meaningful distinction between these criteria. Does the NCUA have examples of the type of securities they would expect to be reported in each of these report lines?
Okay, thanks, Susan. This is Rick again. So there are a lot of new lines in the new Schedule B. So we do, as the question says, we have a general section for federal agency securities guaranteed, and that would have a subline of debt instruments, and the other one would be non-debenture instruments. So the debt instruments, pretty straightforward. A Fannie Mae debenture, a TVA debenture. You know, there's a bunch of callables. A Federal Home Loan Bank callable. Those would go in there. For the non-debentures, it would be typically a mortgage-backed security where it is guaranteed by the agency. An example, a Fannie Mae pass-through, a Freddie Mac multifamily deal where it is guaranteed by Freddie Mac. For the non-guaranteed, we have two lines there too. We have debt instruments non-guaranteed, and then we have non-debenture instruments non-guaranteed. So for the debt instruments non-guaranteed, at this point, we don't know of anything that will really go in there. But in case they do issue something that would be non-guaranteed but issued by an agency, we wanted to be able to capture that. So I don't know of anything at this point, but in the future it might happen. Now, the more interesting one is the non-guaranteed. So examples of that would be a Freddie K multifamily, a subordinated tranche. So they issue Freddie Ks where the senior tranche is guaranteed, which that would go into the guaranteed line, but then they have subordination that is not guaranteed. Something like that would definitely go in there. Another thing that would go in there would be a Fannie Mae or Freddie Mac credit risk transfer securities. So these are where Freddie and Fannie issue basically subordinated tranche reference notes to investors. You know, LIBOR plus 300, very attractive yields, but they are leveraged. They're subordinated and they're not guaranteed. So losses to the underlying collateral would flow through to the investor. So those would go into the non-debenture instruments, non-guaranteed. So hopefully that answers your question. Back to you, Susan.
Okay, thank you. So Vicki, I have a colorful question for you. There are several colors, red, blue, purple, on the mapping documents. Can you explain what these mean?
Sure, Susan. This is Vicki. I'm a systems officer in the Division of Systems, and red is for new information. Red with strike through is retired information. Blue is a reused account code, so if it was used on one page and then used on a different page further back, it'll be blue. And purple is moved information. It was moved from one page to another page. That's the end of my response.
Great, thank you. So let's see, how about a question for Brian? Brian, can you opt in and out of the CCULR each quarter? Or once the election is made, that's it, you get locked in?
Hi, this is Brian Heitman. I'm a Senior Capital Markets Specialist in the Office of Examination and Insurance. The answer is yes, you may opt in each quarter, or opt in or out each quarter.
All right, thank you. The next question I have is for Allison. So Allison, for small credit unions under 10 million, the CCULR and CCIL do not pertain to us. Is that correct?
That is correct, Susan. Thank you.
All right, thank you. Vicki, how about back to you? Are there any relabeling or renaming of the current account codes in the new changes? If yes, how can we obtain a list of account codes?
So all of the account codes are listed in a document that we have. I believe it's in the resources called the Account Code Catalog, and it tells every existing account and every new account and how it might have been, if it was modified, how it was modified, if it was retired or replaced, what account code replaced it. There's also a list of all the account codes used in the March 2022 form on the CU Online page of ncua.gov. I hope that answers the question.
All right, thank you, Vicki. Let's turn to Paul. Paul, how do we opt in for CULR?
This is Paul again. Opting into CULR is going to be very simple. Filling out your quarterly call report, you'd simply go to Schedule H, and the first question is, does your credit union have a CCULR framework election in effect as of the quarter end report date? And if you would like to elect it, you simply click that and select yes. And following that, there's one more question that asks if you're in a grace period or not, which would not apply to the first quarter. And filling out the rest of that would give you some information to help you know if there's any reason why you would not have qualified for CULR. That's it. Thank you.
Thank you, Paul. The next question is for Allison. Allison, CECL requires implementation for fiscal year ends starting after December 31st of 2022. For a credit union that has a fiscal year end of September 30th, they are not required under FASB to implement CECL until 10/1/2023. Why is the call report requiring us to implement 9 months early on January 1st, 2023?
Thanks for that question, Susan. This has been coming up quite a bit, and the only credit unions that can have a non-calendar fiscal year will be state-chartered credit unions. So a federal credit union will have a calendar year, fiscal year, per our regulation, irrespective of what their audit year is. And so I know that some auditors are saying, you know, we're doing audits as of September 30th, and that's the audit year or audit period. And I have been telling credit unions and auditors alike that for that, I'll call it the transition year, that they can just simply do footnotes in the audited financials. I hope that answers the question, Susan.
All right, thank you. The next question I'm going to give to Paul. Paul, what would be an example of a loan that would be reported on page 6, line 11, all other non-commercial real estate loans, lines of credit? It seems the other 10 lines should contain all loan types.
Hello, this is Paul again. It's a pretty unique situation that you'd have an entry there. So I wouldn't be too surprised if a lot of credit unions have no entry. A type of item that could be there, which is probably the most common item that ends up in there, is a loan for a commercial purpose that does not qualify as a commercial loan because of its dollar amount. So a loan under $50,000, and maybe it's just the small remaining balance of some commercial property that hasn't paid off yet. That's the most common thing we see there. Thank you.
Thank you, Paul. The next question is for Rick. Rick, what are the pros and cons of joining the CULR framework as opposed to RBC?
This, again, is Rick Mayfield from Division of Capital Markets. So I would say there are two pros of CULR. One, it's a simpler form to fill out. It's just a one-page form. If you meet the qualifying criteria, it's a lot simpler than filling out the RBC form. So that's the first advantage. The second advantage is that you can actually, if you're doing CULR, your minimum amount of net worth to be well capitalized actually goes from 7 to 9%, and therefore the amount of member business loans a credit union can do actually goes up. So those would be the two advantages. I'd say that the disadvantage of CULR is that you aren't doing RBC, and you could potentially be well capitalized with less net worth if you go that route. It's a little bit more labor intensive, but you could potentially be well capitalized with less than 9%, which would be required by the CULR ratio. And that concludes my answer.
All right. Thank you, Rick. I'm going to stick with you for the next question. CMOS, where would you go?
So this is talking about CMOs, and I believe this had to do with me answering the question of federal agency securities. So I would say 99% of the CMOs, if not more, that credit unions purchase would go into federal agency securities, non-debenture instruments. So it's not a debenture securitization. So therefore, and typically these are guaranteed because the pools behind them are guaranteed. So 99% of the time they'll go into federal agency securities guaranteed, non-debenture. That concludes my answer.
All right. Thank you, Rick. The next question I have is for Paul. To the form where there'll still be warnings issued by the system.
This is Paul again. Yes, there will still be warnings and errors issued by the system. We'll continue to do our best to help guide you if you've made a potential mistake on that. We're always looking to improve it. Thank you.
Thank you, Paul. Next up is Allison. Allison, are regular reserves now included with undivided earnings?
Susan, the short answer to that is yes. Regular reserves are a regulatory construct, and now that it has been eliminated, regular reserves are part of undivided earnings, or what I would like to refer to as retained earnings as defined in GAAP. So yes, they can move it to undivided earnings and report it as such on their call report. Thanks, Susan.
Thank you. Paul, back to you. Are there any changes to the definition and classification of commercial loans versus business member loans?
There are no changes at this time. The biggest change for the commercial loans that we have segmented them off of the real estate loan schedule, so that the real estate loan schedule only contains 1 to 4 family residential loans from now on. Thank you.
All right, thank you. Next, I'm going to go back to Rick. Rick, I'd like to get some specificity about how to report 457F plan investments used to fund employee benefits. Can guidance be provided with respect to what practical expedients can be utilized to determine if the various investments are Part 703 compliant?
Thanks, Susan. This appears to be a two-part question. So let's start with the 457 plan investments used to fund employee benefits. So if the investments are securities, the 457 investments are reported on the balance sheet as either equity securities, trading debt securities, available for fund securities, or held to maturity securities. 457F investments that are not securities will be reported on other sections of the balance sheet consistent with GAAP. In the Schedule B, if they are securities, 457 investments are reported in the same accounting classifications that I mentioned, the equity, trading securities, AFS, or HTM, with added detail. We also have amortized cost and fair value. So lastly, we also have 457 investments that are going to also be reported in line 11 in the Schedule B, assets used to fund employee benefits or deferred compensation plans. And then the assets would be listed by line. Since 457F plans were brought up, we've had questions in the past, and it's going a little bit beyond this, about CDA accounts. And we've had questions. The CDA account is a charitable donation account. It's a separate account that is primarily for donating money to charity, and it's limited to 5% of net worth, and we require a separate account, so a separate brokerage type account or something similar like that. So some credit unions were under the impression, because it is a charitable donation account, that it would go into other assets because it's this unique account. It shouldn't be treated that way. The underlying assets in the charitable donation account should be accounted for like any other assets on your balance sheet. So if there's equities in there, they should go into equities on the balance sheet. If they're fixed income, or if they're trading debt security or held to maturity security, they should go into that category on the balance sheet. So hopefully that'll offer a little bit of clarity about that too. And it's also on the Schedule B, and I believe it's line 12. As far as determining if investments are Part 703 compliant, credit union should refer to Subpart A of Part 703 and the Federal Credit Union Act, specifically Section 157, 1757, 7, 8, or 15. So it needs to be permissible per the Act, and then the Part 703 actually puts some restrictions in, or will let you know what you can maybe talks about structure, or whether if it might be permissible per the Act, but not for 703. But using those two in conjunction should help you determine whether or not they are Part 703 investments. And hopefully that answered your questions. That's it for me.
All right. Thank you, Rick. I'm going to go back to Vicki now and ask Vicki, on page 6, it states to report the interest income, number, and amount of credit union loans. Did you mean interest rates?
Hi, Susan. This is Vicki. So that's an older form. We put on the Call Report Modernization webpage, and that was interest income was actually removed as part of the 60-day comment, as part of the comments we received from the 60-day comment period. That was determined to be too hard for people to obtain, and so we removed that. So please make sure that you're using the most current version of the form, which should be available in the reference materials for this webinar, and also on the CU Online webpage of the ncua.gov website. That concludes my answer. Thank you.
All right. Thank you, Vicki. Since I have you, I'll give you the next one as well. Could someone please repeat the color coding descriptions on the mapping documents?
Okay, this is Vicki again. And so red means it's new information, and red with strike through means it's retired information. Blue, if the account code is blue, it's a reused account. So it was used on a previous page, and then we used it again on a later page. And also purple means that the information was moved, and purple strike through would be the opposite. So it was moved from that page. Purple and not strike through, it moved to that page. That concludes my response.
All right. Thank you, Vicki. And just a reminder, we're going to provide the answers to these questions at a later time, so you'll be able to look that up and view it again if you need to. The next question I have is for Brian. Brian, if we opt into CULR, does that mean we do not have to complete the RBC schedules?
Hi, this is Brian Heitman again. I'm going to tackle a few different questions here along with this one. First of all, I'll just say that a complex credit union is a credit union with over $500 million in assets. So only complex credit unions are required to complete Schedule H and I for CULR and RBC. So the answer to this question is if you do elect CULR and you're qualified for CULR, you do not have to complete the RBC schedules. And so while I'm answering this, I'll also answer the qualifying criteria to opt into CULR. Number one, the net worth ratio of the credit union must be greater than or equal to 9%. That's number one. Number two, exposures must be less than or equal to 25% of total assets. The sum of trading assets and trading liabilities must be less than or equal to 5% of assets. And the sum of goodwill and intangibles must be less than or equal to 2% of total assets. Assuming that those qualifying criteria are met, the credit union may opt into CULR and not have to complete the RBC. And then one other question I'd like to clear up while I'm here is there really is no, other than checking those qualifying criteria, there really is no calculation of cooler. The cooler ratio is equal to the net worth ratio. That concludes my answer.
Okay, thank you. All right. Let's see. The next one I'm going to go with is the proposed instructions state that Part 703 compliant funds, if not using the look-through approach, should be reported in both account RB0023, securities 100% risk-weighted, and RB0032, other investments 100% risk-weighted. Which is correct?
So this is Rick Mayfield. I take this question. So it should be or, not and in both those accounts, but it can be in both of the accounts. So if it's a security, it would go, I believe it would go into RB0023, and if it's a non-security investment fund, it would go into RB0032. So the distinction here is whether or not it's a security, classified as a security, or not classified as a security for GAAP. Hopefully that clarified that question for the person who asked the question. That'll conclude my answer.
All right, thank you. The next question I'm going to go with is, are the CULR and RBC automatically calculated within NCUA Online, or will that be fillable information? Who'd like this one?
This is Brian. I can take that one.
Great.
So it's a combination. I'll start with the RBC form. The initial information from the balance sheet, from the statement of financial condition, will be imported in the leftmost column, but credit unions will be responsible for slotting their individual holdings, individual assets, into the risk weight columns. So all the risk weight columns are fillable. On the CULR form, the opt-in elections are fillable. The assets are auto-populated. The net worth ratio is auto-populated. And then I believe 2 of the qualifying criteria must be entered, and the remainder of the calculations are done automatically. That concludes my answer.
All right, thank you. The next question I have is for Allison. Allison, did you say regular reserves now goes on page 3, number 9, undivided earnings? I heard retained earnings, but I don't see a line for that. What would go on line 10 on page 3?
So Susan, this is Allison, and I'm sorry if my audio is poor, but I did say that regular reserves would now go into undivided earnings. What I commented on was that regular reserves were a regulatory construct, and that terminology, regular reserves, is not in U.S. GAAP. What is in U.S. GAAP is retained earnings. So for our purposes, undivided earnings is where the regular reserves account is now going to go to. Thanks, Susan.
Thank you, Allison. Let's move to Tom. Tom, can we use the 4-quarter ending asset average in determining the CULR?
Hello, and thanks for the question. Let me just start by saying that for the February 23rd on the capital adequacy standards, we will provide examples of how to use the call report, opt into the CULR, on how to use the RBC schedule, and when you're qualified and when you're not qualified. So I know we're getting a lot of questions today on opting into CULR, the qualifications, what's auto-populated, what is not auto-populated. So I just wanted to give you a heads up. For the February 23rd webinar, we will be providing examples on how to use those 2 schedules for Schedule H and Schedule I. Specifically on this question, while I have you today, yes, the CULR threshold is essentially the net worth ratio. So in terms of the calculation options for the net worth ratio, that would automatically feed over into Schedule H for the CULR threshold. So it would be the same exact rate as your net worth ratio. Thank you.
Thank you. All right, the next question is for Vicki. Vicki, on page 1 of the old call report allows for listing CD investments on line 8, which separates under 1 year and 1 to 3 years, etc. Are we not separating this on the new call report, page 1, line 3?
Hi, Susan. This is Vicki. So the maturity distribution schedule that used to be on page 1 of the call report has been moved to page 15, Schedule B, Section 3. So you will need to report the maturity distribution of your time deposits. It'll just be reported on page 15 rather than page 1. That concludes my response.
Okay, thanks, Vicki. Allison, back to you. Are we required to implement CECL on January 1st, 2023 for the call report, even if our fiscal year is different than calendar year? And per the FASB, we do not have to implement until October 1st, 2023?
Thanks, Susan. So I'll try and be a little bit more clear again on this one. Only if you are a state-chartered credit union can you have a fiscal year that is not a calendar year. So to the person or the credit union asking that question, if they are a state-chartered credit union and have other than, if they have September 30th as their fiscal year, they would adopt CECL October the 1st, 2023. That day one charge to retained earnings, if there is any, will automatically be calculated behind the scenes with the call report team. Thanks, Susan.
Thanks, Allison. All right, next question. Paul, we are well under $500 million for assets. So will those forms still auto-populate for us as they have in the past?
This is Paul again. The risk-based capital forms will auto-populate to the extent that you have data you've already entered, regardless of your asset size. The net worth pages that you might be referring to will still automatically calculate everything you need, except for those few rare instances where you might be choosing an alternate or you've had a merger where you'd require entry. But assuming those unique scenarios don't apply to you, your net worth ratio is still going to automatically calculate, and it'll still return an accurate classification regardless of any scenario or any asset size. If you're asking the question more to the side of you wanted to try out the RBC forms or the CULR forms and you wanted to know if they would work for you, you can try them out in the CU Online system at any time, at any asset size, but you would not be able to upload unless you have the correct amount of assets to actually be applicable. Thank you.
Thank you, Paul. Next question is for Tom. Tom, did I understand correctly that credit unions under $500 million do not need to fill out Schedule H or I?
Hi, yes, and thank you. This is Tom, and the answer is yes, you do not have to fill out Schedule H and I if you have total assets under $500 million at the end of any reporting period. Just a general note on capital standards. I noticed because between Paul, myself, Rick, and Brian have been answering a lot of questions on the CULR and RBC. I would strongly encourage reading NCUA rules, Part 702. So Part 702 went under a significant change as of the new year, given the effectiveness of risk-based capital, the CULR framework, subordinated debt, and other changes to our capital adequacy standards. So it may be beneficial for credit unions to read through Part 702, and you'll see that a lot of your questions would be answered there. Otherwise, we'd be happy to answer them, of course. And as a reminder, Feb 23 will have a little bit more of a demonstration on how to use those two new forms. Thank you.
Thank you. Next will be Rick. Can you please explain again what the difference is between debt instruments guaranteed and non-debenture instruments guaranteed?
Yes, I would be happy to answer that, Susan. So I'm going to use examples from what I've seen at credit unions here. So a debt instrument would be if you buy a bullet Federal Home Loan Bank venture. So it's matures in 4 years, has a coupon of 2.5%. You get interest payments every 6 months. That would be the debenture. So that would be the debt instrument. Also a Fannie Mae callable that matures in 4 years and it's callable in 2. That would also be a debt instrument. And it is issued by, in these cases, they're issued by either Fannie or Federal Home Loan Bank in this example, so that would be guaranteed. Now, for non-debenture instruments, it would be stuff that isn't issued directly from the issuer. It's issued through a securitization. So a CMO would be a non-debenture. A Fannie Mae pass-through, a multifamily securitization would also be that. So one is debt. The direct obligor is the issuer, and in this case, it would be a federal agency. And the other one is a non-debenture. So the issue would be guaranteed by them, but it's issued through a trust, and you'll have like a ticker symbol like FN8459, and it's through that trust, and it's part of securitization. So that would be the non-debenture. Hopefully that helped clarify that question. Back to you, Susan.
All right, thanks, Rick. Allison, should we combine undivided and regular earnings account into one account?
So I believe what the question is asking is, should the credit union combine their regular reserves with undivided earnings? And I would strongly suggest that. However, they can talk to their auditor about it. As I've previously said, regular reserves was a regulatory construct and not anything as defined in generally accepted accounting principles or U.S. GAAP. And as Paul, my colleague, said at the top of the webinar, the first 5 pages of the call report are now in compliance with GAAP. So I would strongly encourage them to combine it, but if they want to keep it separate on their financial statements, that's fine. They're just going to have to put it in with undivided earnings for call report purposes. Thanks, Susan.
Thank you. Next, we'll go to Vicki. Vicki, for the maturity distribution on page 15, do we still use the WAL?
Hi, Susan. This is Vicki. Yes, you still report based on the weighted average life schedule, and that weighted average life schedule is still in the instructions. That concludes my response.
Okay, I'm going to stay with you, Vicki, and give you the next question as well, and that is, will there be new call report instructions that align to the new call report form?
The instructions in the form are part of the resources for this webinar, and they align with the form. They're also posted to ncua.gov and the CU Online page. That concludes my remarks.
Thank you, Vicki. Next, I'll go to MJ. MJ, where do we sign up for the February 23rd webinar?
Thank you, Susan. On the NCUA website, there is a section called Events Calendar, and under that Events Calendar page, there is a listing of all of the NCUA's upcoming webinars. Also, usually there is a tile on the main page that says webinar, and it's usually set to like the next webinar that's going to happen. That concludes my answer.
All right, thank you. I'm going to go back to Tom and say, Tom, how will these changes affect NCUA regulations and regulatory exams?
Thanks, Susan. Hi, Tom Fay again. Yes, so the chairman's letter to credit unions back in January 2022 on NCUA's 2022 supervisory priorities indicated that capital adequacy and risk-based capital rule implementation would be a priority for examiners. And so I would be especially mindful starting with the Q1 submission and exam starting afterwards, or maybe a little bit later, a focus on your risk-based capital submission and or CULA submission, if you're complex, of course, would be a focus of NCUA examiners. Thank you.
Thank you. I'm going to go back to Vicki. Vicki, do lines 9 through 12 on Schedule A, Section 1, still have to tie to the real estate section total, which is Schedule A, Section 7?
Hi, this is Vicki. Yeah, so the accounts on Schedule A have to tie back to the accounts reported on the loan page, page 6. So it's Section 1 of Schedule A and Section 7 of Schedule A have to tie. That concludes my remarks.
Okay, thank you. I'm going to go back to MJ about where to find the materials, the forms, and the instructions. MJ?
Thank you, Susan. So I pushed to audience the slide that shows the web page for the CU online information. And let me send the next slide as well. If you scroll down that web page about halfway, there's a spot that says reporting forms and documents. The call report form, instructions, the changes document, the account descriptions are there, and then beneath that, the vendor information. And I realize that some people said that they could not find it in the resources for the webinar, so I'm pointing you to the official and final documents that are on the NCUA website. Thank you.
Thanks, MJ. Another question for you is this webinar being recorded, and will the recording be available at a later date?
Thank you. The webinar is being recorded, and it will be available, I think, almost at the conclusion of this, but certainly not later than early next week. Thank you.
All right. Thanks, MJ. I'm going to go back to Brian. I think we have another CULR question here. And Brian, does the qualifying criteria for CULR auto-populate, or do these have to be inputted?
Hi, this is Brian again. So, as I mentioned previously, it's a combination of the two. There are 4 qualifying criteria. The first one is the CULR ratio, which, as we've mentioned, is just equal to the net worth ratio. In order to opt in, that must be 9% or greater. That ratio will auto-populate. The second criteria is the total off-balance sheet exposures. That those will be auto-populated, and the percentage, the ratio of those to total assets will be auto-calculated. The third criteria is the sum of trading assets and trading liabilities. That is a manual entry, and the ratio of that sum to total assets is auto-calculated. And then finally, the fourth criteria, the sum of goodwill and other intangible assets, is also a manual entry. The ratio of that sum to the total assets will be auto-calculated. That concludes my answer.
All right, thank you. Next, I'll go back to Rick. Rick, what is the difference between an obligation of a U.S. government agency that is directly and unconditionally guaranteed versus one that is conditionally guaranteed?
Thanks, Susan. So let's start with directly and unconditionally guaranteed. So the government will pay it off regardless of what you do. So you own an asset, and you don't have to do any servicing or anything for them to say we're going to pay on it. So conversely, the conditionally guaranteed, the person with that guarantee might have to perform some functions. They might have to perform the servicing properly for the government to actually pay on that guarantee. So it is conditioned on something that the holder of that asset has to do. Hopefully that clarifies that question. Back to you, Susan.
All right, thank you. Next, I'm going to go to Allison. Allison, do the March changes cover the call report CECL reporting requirements, or will changes be made in March 2023 when CECL is in effect?
Thanks, Susan. So at this moment in time, the call report for March does have CECL reporting requirements, bearing in mind that if you early adopt CECL, which technically if you've adopted this year and you're saying that your CECL for this March, then you will not be eligible for our capital phase-in rule that we did. But I have to also state that FASB is undergoing a great deal of changes to the FASB standard. And one that is on the top of the list right now, I expect an ASU to be issued any day now, is they are eliminating TDR classification and measurement for those institutions that have CECL. So by March of 2023, we're going to have to make some sweeping changes to the call report relative to TDR classification and measurement. So other things that are on the horizon for CECL is how to account for purchase credit deteriorated assets versus non-purchase credit deteriorated assets in a business combination. I suspect that that project and a new ASU will be updated before the end of the year. So CECL continues to evolve, and part of that is through the undertaking of the post-implementation review projects. And for those banks, the large banks that have already adopted as of January 2020. So CECL will continue to evolve. Thanks, Susan.
Thanks, Allison. All right, back to Vicki. I see that negative shares was moved. Where has it been moved to?
Hi, Susan, this is Vicki. So negative shares, the reporting of that line item was moved to page 19, along with all the other additional share information that we collect now. So all of that moved to page 19. Thank you. That is Schedule D, Section 2.
All right. Thanks, Vicki. Now going to Paul. Paul, will there be a mapping for the FPR which shows information pre-March 2022 with the new changes?
This is Paul again. Not quite sure what you mean for the mapping document. That could be looked at a few different ways. We do always publish how the FPR items are calculated. We will continue to publish that for the FPR. In terms of will there be a document that shows exactly where things went to another and how to trace accounts through specific FPR calculations, in a lot of cases that's not going to be possible. You know, when we create new account codes, a lot of times it's because we're not collecting information anymore, or we've changed how we're collecting the information. So if there's a specific item you're concerned about, that might be a question to send to CU online at ncua.gov. I hope that answers your question. Maybe I can give you more information through the email question. Thanks.
All right. Thanks, Paul. Let's see. Let's go to Brian. Brian, can you remind me again what the CULR required net worth ratio is versus the required RBC requirement?
Hi, this is Brian. So maybe Tom can help me on this one. I'll start with the CULR part. In order to opt into CULR, net worth ratio must be at least 9%. But risk-based capital is a little different. There isn't an opt-in or an opt-out. Tom, can you help fill in the blanks on that part?
Yeah, sure. Hi, everyone. Tom Fay here. I believe the question is, what were the rate thresholds for both RBC and CULR? CULR is a standalone framework. If you opt in and you qualify, And what you need is a 9% net worth ratio at the time of the opting in. That would qualify you to be well capitalized and excuse you from reporting any risk-based capital requirements. If you do not qualify for CULR and you are required to fill out an RBC form, then you would need to have at least a 10%, and we'll go over this, by the way, on the Feb 23 webinar in detail. You would need a 10% risk-based capital ratio as well as a 7% net worth ratio in order to be well capitalized. Thank you.
All right, thanks, guys. Rick, I'm going to go to you next. In the new rules, what is the precise definition of a complex credit union?
Thanks, Susan. So in 702.103, the definition for purposes of Section 702.102, a credit union is defined as complex and a risk-based capital measure is applicable only if a credit union's quarter-end total assets exceed $500 million as reflected on its most recent call report. So you can find that in our rules and regulations 702.103. That concludes my answer.
All right, thank you, Rick. Next will be Allison. Allison, will we still have an allowance for loan loss on our March call report?
So, Susan, if the credit union is asking, and it's March 31st, 2022, yes, the allowance for loan and lease losses will still be there. For after, post-CECL, that's going to still be on the call report, especially for those credit unions under $10 million that don't need to comply with CECL, and further for those state-chartered credit unions who don't adopt CECL until the last reporting of October the 1st of 2023. Thanks, Susan.
All right, thank you. Let's see, Paul, do any of the fields from the detailed schedules populate in other schedules so that I don't have to retype the numbers?
This is Paul again. Currently, there are a few items that may be that way, but for the most part, we don't have subschedules populating the main schedules. And I know a lot of times people might be used to accounting systems or maybe used to seeing that. We haven't done that at this time, but we hear the suggestion. Thank you.
Okay, thank you, Paul. Tom, I'm going to go back to you. How would opting into CULR increase the member business loans cap?
Thanks, Susan. Good question. We will provide an example at the February 23rd webinar on a slide so you can see exactly how the calculation works. But in essence, and I'll answer this today as well, you first need to determine what your minimum capital level will be in order to be well capitalized. So if you're complex and you opt into CULR and you satisfy at least 9%, where the 9% is your requirement to be well capitalized, then you determine the 9% of your total assets, and that amount times the 1.75 is your MBL limit. And again, we'll provide an example on this on a slide at the February 23rd webinar. Thank you.
All right, thank you. So, Brian, we have somebody who's confused. He wants to know, do you have to do the RBC or CULR, or if we are a complex credit union, can we pick one of the two?
Hi, this is Brian. So credit unions will only need to complete one of the two forms. If they elect into CULR, if they are eligible and they qualify, then they will not need to complete anything on the RBC schedules. Conversely, if they do not opt in or they do not qualify or they are not eligible for CULR, then they will have to complete the RBC schedules, one or the other.
All right, thank you. So, Rick, on page 15, would number 1, time and other deposits, be where I would list CD investments?
So, Susan, thanks a lot for that question. This is Rick again from Division of Capital Markets. So it might be. So if it is a non-security, that's where it would go. However, some CDs have QSIPs and are securities, and those would actually go in either trading debt securities, AFS, or HTM. So non-securities would go into line one, and then securities would go into one of the other securities categories. That concludes my answer.
All right, thank you. Let's see. I have a question about the CAMEL S webinar. So, Rob, I've not been able to find the March 10 CAMEL's webinar on the NCUA website. Do you know where that is?
Hi, Susan. This is Rob Bruno, Senior Capital Markets. The CAMEL's webinar is scheduled for March 10th at 2 o'clock, and it has not. The registration link has not been provided yet. We're just at that cusp of a 4 weeks until the webinar. We will be providing that registration link, I would say, within at least the next week, maybe even sooner. So please be looking for it. Thank you.
All right, thank you. Next, I'm going to go to Laura. Laura, should loans that were sold to FHLB but serviced by the credit union be added to the amount of loans granted year to date? That would be page 11 of the new report.
This is Laura. Report the number and dollar amount of loans granted year to date, include all loans for all types granted, including real estate loans sold on the secondary market. That concludes my answer.
All right, thank you. Rick, on the new Schedule B, does the amortized cost have to be filled out for those bought at par?
So the answer on that is yes, but it's a very easy calculation. So if you buy a debenture at par and you paid $1 million for it, and it's still on your books and it somehow didn't amortize down, it would be put on the call report at $1 million, because your amortized cost would still be the amount that you paid bought it at par. That concludes my answer.
Okay, thank you. I'm going to go to MJ at this point. MJ, a lot of the info that's in these Q&As, they'd like it to be available somewhere after the presentation. Their CFO is out today, but they'd like them to see it. So where can they find this?
Thank you, Susan. We will be working to develop an FAQ, and we hope to publish it soon. We may have to do it in batches because we've received quite a number of questions, and we're looking to do that as timely as possible. I just don't have a specific date yet. We will keep you posted.
Okay, MJ, I'm going to stay with you with another question about the webinar. They'd like to know if this training is going to be repeated before the March call report is due. Will a recording of this be sent out to all of the registrants?
Thank you. All of the registrants will receive the link to view to review the recording for today's session. Yes.
Thank you. All right, Rick, is Freddie Mac debt instrument guaranteed?
So the short answer is yes, but make sure it is in fact a debt instrument. So they do have, as I mentioned earlier, they do have some non-debenture instruments that are non-guaranteed, but yes, a Freddie Mac instrument is guaranteed. Back to you, Susan.
All right, thank you. I'm going to go to Rob now. Rob, do we use prior quarter off-balance sheet exposure to elect for CCULR, or is it based on current quarter and Schedule C?
Thanks, Susan. To calculate the off-balance sheet exposure as part of the CCULR election, you'll use the current quarter exposures. So, for example, for the March 31st, 2022 cycle, you'll use the March 31st off-balance sheet exposures to perform the calculation. Thanks, Susan.
Thank you. I'm going to throw this now to Allison. Allison, are there planned updates to the call report for the new lease standard?
Thanks, Susan. So the new lease standard, ASC 842, those changes in the call report were actually effective December of 2021. There's been no change since that point in time. And so all those right-of-use assets are going to go on other fixed assets, which is account code 008. But if the question is also kind of geared towards, will there be any type of exception because right-of-use assets are going to increase the balance sheet and potentially dilute net worth, if that were to happen, is there any sort of a concession? And the short answer to that is no. There's going to be no concession for any increase in assets due to bringing leases on balance sheet. So again, it's going to go in other fixed assets, account code 008. Thanks, Susan.
Thank you. All right, so if a credit union opts into CULR but does not qualify in a specific quarter, will there be an error that forces them to opt out and complete the RBC? Paul, would you like this one?
This is Paul again. Some of this question veers into what's probably going to be covered on the CCULR webinar later, but I'll tell you how the form works. If you don't qualify, you will get a warning, but because there is a grace period where you can be out of compliance with some of the qualifying criteria, we have not designed it to stop you from reporting. So if you're in the grace period, your examiner will know that you're in the grace period, and if they see that you exceed the statutory limit of grace periods in your filings, I'm sure they'll be contacting you to ask you to correct the call report, and then you would need to do RBC. But the system itself is not going to prevent you from filing that way simply because there is that grace period. Thank you.
All right, thank you, Paul. So let's go to Vicki. Vicki, were the number of days delinquent modified from the December 2021 call report?
Hi, this is Vicki. Yeah, the number of days delinquent changed. We have 30 to 59 days, and 60 to 89 days, and then 90 to 179 days. So the 60 to 89 days column is new. We have added that. That concludes my answer.
Great. Vicki, I'm going to stay with you for the next question. They'd like to know, when will the March 2022 call report be available in CU Online for input?
So I believe April 1st it will be available in CU Online. That concludes my answer.
All right, thank you. The next question I have is for Simon. Simon, on page 6, line 18, if the modification term has ended, is the loan still reported here?
Thank you for the question. This is Simon Herman from the Credit Division. This question regards eligible loan modifications under the 2020 CARES Act. So once the term of a 401(c) eligible loan modification ends, credit unions should no longer report the loan. That concludes my response.
All right, thank you. Next question is regarding Schedule B. Let's see, we do not need to break out investments by banks and natural persons credit unions. Rick.
This is Rick. I'm happy to answer this. You do not break out the investments between a bank and a credit union, but they will be broken out whether or not they are securities or non-securities. That's really where those might be different. So if you buy a bank CD and it has a CUSIP, that would go into securities. But if you make an investment in a natural person credit union and it's not a security, that would be in a non-security. So one might be a security, one might not. But that would be the only distinction. Back to you.
All right, I'm going to conclude the questions at this point and kick it back to MJ. Thank you.
Everyone, we have reached our time limit and have answered as many questions as possible. We will publish them and we will get them out as soon as possible. Again, thank you for your participation. This concludes the webinar.